Hey there, YouTube. Welcome to the 5 Minute Market Outlook. We're going to go over some economic updates from last week, as well as updates coming up this week. And towards the end, I'll get into my thesis of where the market is headed and a couple of trade ideas that I will be executing based on this belief. So with that, let's jump in. On Tuesday, balance of trade narrowed down to about 60 billion. This is what Trump is trying to fix with the tariffs. We're at about a $1 trillion trade deficit per year. And with his tariffs, he's hoping that we import as much as we export. Right now, we're exporting about $1 trillion extra than what we're importing. So that's that trade deficit. This looks like a positive for what he's trying to achieve. But we're going to talk a little bit more about this in just a minute. Non-manufacturing PMI came in on Tuesday as well. This is just manufacturing. Employment fell to 46.4 versus 47.2. This is a diffusion index, so anything below 50 is considered contractionary. I've been talking about this for a while, that ISM's PMIs are reporting contraction within the manufacturing sector. So this remained in contraction for the second month in a row and fourth time in the last 5 months. So continued slowing. And this really does provide that tariffs are having an impact on manufacturing and impact on global trade. You have initial claims, so think of this as people that are coming in every week to get their unemployment. That's actually falling. It was reported around 218, 219 this last week, but what's important to me is the continuing claims. So you can definitely tell that it's taking longer for people to find jobs just by virtue of the continuing claims to be going north. Right now, every week, continuing claims is climbing, and we're around 1.97. This is important to note because this is weakening in the employment sector. In fact, Michelle Bowman was one of the dissenters last week, where she opted for a rate cut for July. She was one of the participants in the Fed meeting that wanted to drop rates. But because the majority wins, they didn't drop rates. But on Saturday, she indicated that because of this weakening in employment, she is planning to vote for the next 3 meetings. There's 3 meetings left. She's planning to vote for a 0.25 percentage cut at each one of those meetings. Right now, we have a 50 basis point cut expected by the end of the year. I'll show that here in a little bit. But she's expecting 75, and that's what she's going to vote for. This is going to be interesting because Adriana Kugler also resigned. That means you're going to have a third person that'll be appointed by Trump that will most likely be very dovish. So now you're going to have 3 people, because you've got Waller that wanted a cut. You've got Bowman that's saying she's going to do this cut. And then when Trump appoints this third person, that's going to be another person in the camp of rate cuts. You can just about guarantee that there are at least one more, but probably 3 cuts at the end of the year. Right now, there's only 50 basis points. I'll jump into that at the end because there is a trade potential as well on that one. Okay. Contributions to GDP. While I did not cover this last week, I did want to show this week, just to go into a little bit more detail. So the way this works is, here's your GDP on this side. You've got C plus I plus G, X minus M. It's basically C plus I plus G plus X minus M, exports minus imports. And that the last two is what Trump is trying to fix. What ended up happening, there was about a 30% drop in imports. So a big drop in imports. You'd think initially that's good news, but really what happened is you had a buildup of inventories. That's reflected on the investment side. If you look underneath investments, the I is made up of fixed investments and inventories. So inventories had a huge drop. That kind of makes sense because there was probably a lot of front running with the tariffs in the first quarter. And now you have a big drawdown in inventories because they were front running the tariffs. That said, you would also expect a drawdown in imports because of the buildup in inventories. So really, this GDP is very distorted from times past, and it'll take probably another quarter or two for those distortions caused by the tariffs to work their way out. But there is expected weakening on this side as well. I'll go through that here in a second. With the World Economic Outlook, you can go out and take a look at the IMF, and they will provide their forecast for different regions. And you can see that they are expecting the United States at 1.9 GDP by the end of the year. So there's just some definite cooling, and 2% for next year. Europe, they're expecting to drop as well. And then you've got some of the emerging countries, emerging areas that are expected to be higher GDP. You'd kind of expect that. But if you want more information, go ahead and jump into that. All right, so let's go into the market. So from just some weakening noted within the market, what I'm showing here is 50% of stocks are above their 50-day moving average. It's in green. 50% are above their 200-day moving average. You can see a couple of weeks ago that you had about 75% of stocks reporting above their moving average, which would indicate some strong momentum. So the momentum is definitely weakening. There are other oscillators as well that's showing some weakening underneath the surface, even though the stock market is near all-time highs. VIX is your fear index, almost, if you will. It's a measure of implied volatility. It's basically how many puts are being bought, and the more puts that are being bought, this number reflects that in its implied volatility exactly 30 days out from now. So you can see that that's been dropping. It had a little bit of a spike because of last week's unemployment report. It dropped, it waned. People are becoming complacent. There's not a lot of fear in the market, which is partly what's driving the market higher. The VIX indicator is indicating bullish, whereas the previous indicators I was just showing are indicating neutral to maybe some waning. So jumping into 10-day returns over the last several years, actually going back to 1950. This was done by Carson Research, and this illustrates the September effect. You can look at August as one of the weakest, and September is the weakest month of the year. So there is some underlying weakness we just looked at with indicators, but now we're looking at some historical analysis, and the worst 10 days of the year is noted right before September 16th. The September effect is caused by, theories are, that mutual funds could be resetting. There's some sell-off. A lot of companies have fiscal years that end in September, so they're selling and redistribution of assets, and that's what causes this thing to happen. So typically you'll see that August and September are some of the weaker months of the year. So that said, I'm going to be positioning to be neutral to slightly bearish. There's definitely warrants some caution even with the oscillators that we looked at. So earnings still are showing very well, very strong. If you can see this, but earnings went up this last week to 282 per share for the S&P, which is 22.4 PE. That's still relatively high. We are above the 20-day moving average, the 50-day moving average, and the 200. So strong momentum, but some weakening. You also have MACD on a sell signal and RSI in the neutral range. So given that, probably what I'm going to do, I illustrated last week that I had some straddles and strangles at this point, so I'm playing a neutral. What I will be doing over the next week or two is something a little bit different. I'm going to buy a call here, sell a call up here, so I get some protection here. So I'll get protection all the way up into about that 665 range. I don't see us going to 665. And then what I'm going to do is I will be selling the market. So I'm going to sell the market short, but I'm going to give myself a little bit of a cushion up here. And then what I'll do is I'll come down here and I'll probably sell a put down in this range so that I can finance my insurance. This is going to be insurance up here so that if it continues up, well, then I should not lose, but I'm also going to pay for the insurance by selling a put down here. So I'm going to offset this, but that gives me some upside protection because I'm shorting the market. I will give myself some upside protection to about that 665 range, which is another about 4% above where we are. Knowing that August and September are relatively weak, I don't expect a 4% increase from where we're at today. So I will be making this trade. What's coming up this next week? We've got inflation. I am out of interest rates for the time being. I want to wait till we get the interest rate report on Tuesday, and then I will probably let it settle till Wednesday before I make a trade. I will most likely be straddling the long end of the curve. So think of the 20-year, the 10-year. I will be making some straddles, which will give me a 25 to 30 basis point range of profitability. I'll just let time decay work its way out. I don't see the long end of the curve dropping significantly or increasing significantly. I think it's pretty range bound for now. Depending on how inflation looks, if inflation comes in hot and you can expect the front end of the curve, here's the curve, you'll expect the front end of the curve to come down and the long end of the curve probably stay somewhere in this range. So that said, I will be playing the 2-year by buying calls and possibly selling puts if the inflation comes in hot. I will wait for my determination there. But if that 2-year rate goes up, you will know that I will be selling puts here because I don't expect the 2-year to go above 4%. And that's where I'm going to be selling my puts is around that 4% mark. If it's really hot and it hits that 4%, then I'm going to be selling puts and buying calls. So that is going to be my trade thesis. A couple other things coming up. You've got a lot of Fed speakers, so be watching those because they'll probably be talking about cuts. And if that's the case, the market will price in cuts. A lot of it's going to depend on what we see with inflation. You also get PPI, which is inflation for wholesalers, and then retail sales. These are some pretty big events that are coming up. So for interest rates, watching for interest rates this week, they will be volatile. And speaking of which, where we're pricing in cuts at this point is we expect a cut in September, almost a 90% chance of a cut in September, a cut in October, it looks like, and then a cut in December. So 3, possibly 2, depending on how you read it. But and this is just because you got 46 and 42. That's the way I'm saying that, because that was almost a 50-50 chance. Inflation is going to drive that this week, I promise. So keep an eye on that. And one last thing, cattle prices. I've been talking to you about cattle, how high they are. Look at this right here. It had a 6-point drop. Now, I looked for the news. Did Mexico open up its gates? No. Anything new with the screwworm? Nope, nothing like that. So it looked like it was a technical sell-off of people locking in profit. If that's the case, there was no catalyst. You would probably expect to see that price rise again. It does. That might be a good opportunity to maybe buy some puts. I may look at adding to the position on that. So with that, thank you very much for watching this video. And if you like it, please subscribe. Please drop a couple of comments down below and let me know if there's anything else you'd like to see. With that, happy trading, and we'll see you next week. Thanks.